Hi, welcome to Iron Financial. This is the show where we forge stronger portfolios by cutting right through the market noise. Today, we're putting an absolute titan on the anvil, Eli Lilly. We're talking about a company that has built a nearly trillion-dollar empire, a name that's dominating every financial headline, and let's be honest, a lot of portfolios too. From the outside, it looks like an impenetrable fortress. But here's the thing. Every fortress, no matter how tall, needs a thorough stress test. So we're here to ask the tough questions. Is this a stronghold built on solid bedrock, or is it a glittering facade that's about to show its cracks? Let's get to work.
Yeah, that's exactly right. I mean, the market has priced this thing for utter perfection. It's priced as if Lilly is going to dominate the entire planet forever without a single misstep. But we all know that the higher they build them, the harder they can fall. So the question we are really hammering on today is blunt. Is this trillion-dollar fortress about to face its first real earthquake? We're not here to join the parade and celebrate. We're here to put on our hard hats, inspect the rebar, check the welds, and find out if this thing is really built to last. Okay, here's our blueprint for today's deep dive. First, we are going to build the bull case. We'll lay out the sheer unstoppable power of the Lilly juggernaut so you can understand exactly why Wall Street is so euphoric. Then I'm going to let this guy loose with his sledgehammer to expose 3 potential cracks in the armor. After that, we get serious. We're pulling out the financial calipers to weigh the raw numbers, putting the bull arguments right up against the bear concerns. And finally, we deliver our judgment, the iron financial verdict. Let's get into it.
Look, before you can even begin to understand the sky-high valuation, you have to have respect for the force that created it. We're talking about a commercial juggernaut, the likes of which the pharmaceutical world has rarely ever seen. The momentum we're seeing here isn't just strong, it is genuinely historic. This isn't some slow, steady growth story. This is a full-throttle assault on some of the biggest markets in medicine, and the numbers it's putting up are frankly mind-boggling. All right, let's kick things off with the headline number that's fueling this entire narrative, 54%. Just let that number hang in the air for a second. We're not talking about some small-cap biotech with a single promising drug. This is Eli Lilly, a nearly 150-year-old industrial behemoth, posting year-over-year revenue growth that would make a Silicon Valley startup blush. This is the kind of explosive power that doesn't just change a company, it reshapes an entire industry. It's the rocket fuel for the bull case, and it's easy to see why. Now, this is how you build a financial fortress. And it's not just about that massive top-line number. $17.6 billion in one quarter is staggering. It's about the engine room. Zero in on that key product revenue line. We're talking about the new blockbusters, Mounjaro and Zepbound. That segment didn't just grow, it more than doubled, 104% growth. That tells you the engine isn't just running smoothly, it is screaming at the red line. The new drugs are carrying the entire operation, and that translates directly into a massive non-GAAP EPS of over $7. That, right there, is operational excellence forged in iron. And here, this is the battlefield. This is the incretin market. It's the multi-hundred-billion-dollar global war for the future of diabetes and obesity treatment. This was supposed to be a fair fight, a duopoly between Lilly and its rival Novo Nordisk. But as you can see from this chart, Lilly didn't come to share the kingdom, they came to conquer it. They've seized nearly 58% of all U.S. prescriptions. They are systematically and forcefully taking market share from their #1 competitor. This isn't just market growth, this is a conquest. Okay, the crown is definitely shiny, I'll give you that. But hold on a second. I think I'm seeing a potential chink in the armor right here. The slide mentions a change at CVS. The earnings report even confirms that TRX, which is total prescriptions, actually took a slight dip. Is that the first sign of a breach in the walls?
You have to be careful there. That's a classic case of looking at the wrong data point. You're looking at logistics. I'm looking at the front line of the battle. The real war is for new patients, and that's the NBRX number, new prescriptions. And that figure has surged to an incredible 71%. So what that tells us is, yeah, there was a minor hiccup with some insurance coverage for existing patients, but the tidal wave of new patients flooding in is more powerful than ever. It's completely overwhelming any minor friction. That's not a chink in the armor. That's the sound of the front gates being smashed open by overwhelming demand.
So the present is incredibly strong. We've established that. But a true fortress isn't just about the walls you have standing today. It's about the new towers and fortifications you're building for all the battles to come. And this is where the Lilly story gets even more powerful. This is not a one-trick pony. The R&D engine at this company is a critical part of its structure. A perfect example is the recent FDA approval of Inlorio for breast cancer. While the whole world is fixated on the GLP-1 drugs, Lilly is quietly forging its next generation of blockbusters in totally different arenas, like oncology. And this is just a quick snapshot of how deep that pipeline really is. This isn't just about one or two future drugs. Just look at the sheer breadth of what they're working on. You've got Kisunba for Alzheimer's, which just got the green light in Europe, a market with staggering potential. You have Jaypirca making huge strides in treating leukemia. You've got orforglipron, their next-gen oral GLP-1 pill, acing its final stage trials, not one but four of them. And then you have Verzenio, an existing drug that continues to show incredible data, expanding its use in breast cancer. This is a multi-platform, diversified pipeline. It's a structure that is being engineered to withstand patent expirations and new competitors for decades.
All right, I concede. The bull case is strong. The fortress looks imposing from a distance. But now it's time for a closer inspection. It's time to get right up to the walls and see what they're really made of. Because every fortress has a vulnerability. Every structure has its stress points. And from our deep dive into the Trefis research and the company's own financials, we've zeroed in on 3 potentially significant cracks that could threaten this entire edifice. It's time to find out if this thing is truly built to last. Here they are. These are the 3 critical pressure points we are going to put under the microscope. First, the unavoidable GLP-1 price war. The golden goose can't lay golden eggs forever, and competition is coming. Second, the rapid collapse of their older drug portfolio. The old foundation of the company is crumbling faster than many people realize. And third, what I'm calling the capex overhang. This mountain of cash they're spending to build for the future creates its own enormous risks. Let's break each one down. Let's start with the biggest, most obvious crack, the inevitable price war. Trefis uses the polite term gross margin compression. Let's just call it what it really is, the party's coming to an end. And you don't have to take my word for it, we have a smoking gun. Lilly's main competitor, Novo Nordisk, has already gone on record telling Wall Street to expect a sales decline in 2026, and they specifically cited U.S. pricing pressure. The price war isn't some distant threat, it's already here. Add to that the Inflation Reduction Act, which will force Medicare to negotiate prices, and you have a government-backed siege on Lilly's profit margins. The fortress walls are about to get hit with heavy artillery. Now for the second crack. While everybody is mesmerized by the shiny new drugs, the company's old portfolio is literally falling off a cliff. We're talking about drugs that used to be cornerstones, like the insulin Humulin and the cancer drug Alimta. Wall Street is projecting sales declines of over 25% and 30% respectively. This isn't a slow, gentle erosion, it's a catastrophic collapse. So the billion-dollar question becomes, can Mounjaro and Zepbound grow fast enough to not only drive new growth, but also backfill this massive accelerating hole in their revenue base? That is a much, much heavier lift than just looking at the headline growth number. I see that $50 billion as a sign of supreme confidence. They're not just patching up the fortress, they are building a brand new empire, scaling up their manufacturing to meet a level of global demand the world has never seen before. This is what dominance looks like in practice. I see a $50 billion anchor. The Trefis report points to what it calls significant execution risk, and they are absolutely right. These are unbelievably complex projects. One construction delay, one regulatory snag, one contaminated batch, and that anchor starts dragging the entire company's balance sheet down into the mud. You call it dominance, I call it a high-wire act with no safety net. You're betting the entire kingdom on flawless, perfect execution. And this quote from Trefis perfectly sums up the immediate financial consequence of that $50 billion bet. Their net income, the official profit that accountants calculate, looks fantastic. But their free cash flow, the actual hard cash that piles up in the company's bank account, is seriously lagging behind. Why? Because nearly every dollar of profit is being immediately poured into concrete, steel, and sophisticated equipment for these new plants. So while the profit and loss statement looks pristine, the cash flow statement is telling you a very different story. A story of massive reinvestment that for now is a huge drain. That cash isn't going to shareholders, it's going straight into the ground. All right, we've laid out the bull case, we've identified the potential stress points. Now it's time to put them on the scales and see how they measure up, head to head. We're getting out the financial calipers to measure the core metrics. We're going to look at valuation, growth, and profitability, all in one go, to see if this company's premium price is justified by premium performance, or if those stress points are already showing up in the numbers. So let's start with the price tag. And honestly, this one chart basically is the entire bear case. Eli Lilly is trading at a price-to-earnings multiple of nearly 49. For comparison, the median PE ratio for a company in the S&P 500 is less than 25. You are literally paying double the price for $1 of Eli Lilly's earnings than you would for the average blue-chip American company.
Historically, almost no company of this size can maintain that kind of valuation for long. It means the market isn't just expecting good performance, it is pricing in absolute world-conquering perfection for years to come. There is zero margin for error baked into the stock price. Of course you pay a premium. You don't build a world-class fortress with off-the-shelf materials. This table shows you the superior grade steel that Lilly is forged from. Let's compare. Revenue growth, 45% for Lilly versus just over 6% for the median company. That's not just growth, that's hypergrowth. And profitability? An operating margin of over 44%. That is more than double the S&P median. This isn't just a good company. It is an elite financial machine. You do not get to buy that kind of performance at a discount. But that brings us right back to the central conflict, the real tug-of-war happening inside these financials. This slide puts the bull's powerful engine right next to the bear's potential drain. Yes, that operating margin is a jaw-dropping 44.4%. The profit engine is an absolute monster, but the free cash flow margin is a below-average 10.8%. All of that amazing operating profit is not making its way to the company's bank account. It's being diverted. It's being reinvested into that $50 billion manufacturing gamble. So the whole investment thesis really comes down to one question. What's the return on that massive investment going to be? If it pays off, it's a genius move. If it doesn't, it is a colossal drain on shareholder value. Okay, so with all the evidence laid bare, the undeniable strength of the bull case, and the very real structural risks of the bear case, it is time for the final verdict. We've inspected the foundation. We've tested the walls. For an investor putting their capital to work today, is Eli Lilly a generational opportunity to buy into a dominant fortress, or is it a perfectly constructed trap, priced for a level of perfection that may be impossible to deliver? So let's boil it all down. The bull case, on the left, is built on undeniable, hard facts. You've got explosive 54% revenue growth. You have a dominant 58% market share. You have a deep, multi-platform pipeline that helps secure the future. And you have massive, confident reinvestment in that future. These are all signs of an incredibly powerful company.
But the bear case on the right is just as factual, just as real. You have an extreme 49 times PE valuation that demands perfection. You have very real pricing pressure coming from both competitors and the government. You have a legacy portfolio that is actively collapsing under the surface, and you have $50 billion of capital expenditure that carries an immense amount of execution risk. You cannot just ignore these facts.
And all of this leads to a critical concept for any investor: asymmetric risk. It's a fancy Wall Street term for a very simple idea. A situation where your potential downside is much greater than your potential upside. Think about it. At this high of a valuation, so much of the good news is already reflected in the stock price. Another great quarter or another drug approval might not move the needle that much higher. But any misstep, a manufacturing delay, a pricing concession that's worse than expected, a competitor's surprise success, could cause a major, painful drop. The risk-reward profile here is skewed heavily against you. So here it is, the iron financial verdict. Eli Lilly is, without a shadow of a doubt, a fortress of growth. The company's operational performance is world-class, its market position is dominant, and its pipeline is robust. The fundamental strength of this company is not in question. However, it is a fortress that has been built on a very, very expensive piece of land, and that foundation has potential fault lines running through it. The verdict isn't a simple buy or sell. It is a clear-eyed acknowledgement that when you buy this stock today at this price, you are paying for perfection. You are betting that none of those risks, not the price wars, not the capex delays, not the legacy collapse, will ever truly materialize. So, we turn the final question back to you. We've shown you the strength of the structure, and we've pointed out the potential cracks in its foundation. We've laid the bull case and the bear case bare, with all the facts on the table. So now, the decision is yours. With the risks laid bare, is this a foundation you would build your portfolio on? That's the work you have to do for yourself. Thanks for joining us at Iron Financial.